Welcome to Sectors Up Close. I'm Elena Casas. Today we're talking German stocks and my guest is Joachim Klement, Head of Strategy at Liberum Capital. Germany's economy is shrinking. Data out on Monday morning showed a 0.1% fall in GDP in Q3. That's not as bad as economists were expecting, but it does put the country halfway into a technical recession. It is forecast to contract again next quarter, with the IMF predicting GDP will shrink 0.5 percentage point this year, making it the world's worst performing major economy. Its gas-guzzling manufacturing firms took a big hit from last year's surge in energy prices, partly because of the country's previous dependence on Russian fuel, while the sluggish recovery in its biggest trading partner, China, and tighter ECB policy have not helped. That means German stocks are starting to look cheap. This is the iShares Core DAX ETF, down about 4% just in the last month. Some of the biggest names here are SAP, Siemens, Allianz, Deutsche Telekom and Mercedes-Benz. Well, for more, I'm joined now by Joachim Klement, Head of Strategy at Liberum Capital. Joachim, hi, thanks for coming in. Most economists are fairly bleak about the medium-term outlook for the German economy, but I know you think it might not be as bad in 2024 as some are forecasting. Why not?
Yeah, I mean, the German economy overall is much more reliant and dependent as well on exports. And they're mostly on exports to both China and the US. And the good news for 2024 is that the US economy is holding up quite nicely and much better than other European countries or the UK for that matter. And in the second half of next year, we expect the Chinese economy to recover as well, giving Germany a bit more of a boost. So while the near-term outlook over the next 6 months is certainly bleak, we are definitely more optimistic for the second half of next year.
So if there are bright spots here, as you say, which sectors are they in?
Yes, the German equity market is definitely attractively valued by now. In fact, most German companies are cheaper than their European peers. But unfortunately, as the bad news about the German economy is priced in, it also means that the expectations for profitability are lower than for the rest of Europe. There are two sectors where I think the combination of attractive valuation and higher than European average profitability are an interesting combination. And that is on the one hand telecom and on the other hand chemicals.
So which companies should international investors be looking at?
One company that we particularly like in the telecom sector is Deutsche Telekom because it has more than 50% of its revenues from the US, from T-Mobile US. And there, the recent merger with Sprint will enable the company to unlock a lot of cost savings and could easily boost the share price by 20%. Another stock that we particularly like is in the chemical sector, which is Brenntag, which is essentially insulated from a lot of the cost pressures that we have in other chemicals manufacturers because it's the world's largest chemical distributor. And for distributors, the advantage is that they are less dependent on how high the prices for chemicals are because they're playing essentially the spread between the prices at which they buy chemicals from producers and at which they sell it to industrial clients.
As we've mentioned, the German economy has had a difficult transition away from Russian energy in the last 18 months. Energy prices are still high and much of the economy is still reliant on manufacturing industries that are very gas heavy and also, of course, on the traditional automotive sector. How well is the German economy doing at moving away from those to industries of the future?
At the moment, not very well. To be on the bright side, Germany has a lot of businesses that are well-established market leaders in high-tech manufacturing. Those are the industries of the future. Unfortunately, it is the automotive industry and traditional machinery and electronics industry that is lagging behind, and that at the moment is even struggling to keep up with the pace towards net zero and changing towards, for example, electric vehicles that you see in other nations.
And as you've said, Germany's car makers are behind in that transition to electric vehicles. Are they catching up?
They try to, but all the earnings this quarter have shown that they're struggling to sell their EVs. There's not a lot of demand and the price pressure and the margin pressure is very, very severe across the world. Plus, it turns out that German manufacturers don't have that brand loyalty in customers when they switch from internal combustion engines to electric vehicles, which means that the Chinese manufacturers, for example, can gain market share in Germany and in Europe very, very quickly.
You've mentioned some picks already then, but if we look at the DAX more broadly with those headwinds, is it a sensible bet for foreign investors?
I think at the moment it is a situation where the DAX overall is very cyclical, and since we expect the economy, not just in Germany, but all over Europe and the US to slow down in the first half, we would stay away from an outright flat DAX investment. But we do think that particularly in spring, summer, it might be a good opportunity to buy into the recovery that we expect for later 2024.
Joachim Klement, Head of Strategy at Liberum Capital, thank you so much for joining us. Well, that's your roundup of German stocks. I'm Elena Casas, and this is Reuters.